Welcome, everyone. I'm José Filipe Correia Guedes, Academic Director of the Master in Finance program. Welcome to the Masterclass today. The Masterclass today will focus on financial stability and what banking regulation can do to achieve financial stability. Our guest speaker is Professor Eva Schlipak. She's a professor at Católica-Lisbon. She was formerly a Lamfalussy Fellow at the European Central Bank, a John Kennedy Fellow at Harvard, and a visiting scholar at MIT. She got a PhD from Magdeburg in Germany, and she is an expert on this topic. This topic is very relevant, in particular because the Nobel Prize in Economics this year was awarded to Dybvig, Diamond, and Bernanke, which were the leading scholars, finance scholars, in understanding the fragility of banking and how a regulation can address that inherent fragility of banking. So it's my pleasure to welcome Professor Eva Schlipak, and we are looking forward to your presentation. Thank you, Eva, for being here today with us.
Thank you. So I hope you can all see my screen, my shared screen. So thank you very much for having me today. It's a great pleasure for me to talk about this topic and to introduce a bit the research that Ben Bernanke, Diamond, and Dybvig founded or started with, basically, because this is the main research I'm investigating and I'm developing further insights based on. So you might have wondered about the unusual title, but I hope that during my talk this will become clear. But if at any point something is not clear to you, please don't hesitate to ask for clarification or just for interest. Okay, so José Filipe already mentioned that you might have seen in the news this picture of three, well, very different persons that were assigned with the Riksbank Memorial Prize in memory of Nobel. And it was given for broader topics on financial fragility of the banking sector. But who are these three people, and why was their research and their the insights of their research so important that it deserved the Nobel Prize, especially at this point in time today? So probably you all have heard about Ben Bernanke already, so a very famous person because he served as the 14th chairman at the Fed during the time of 2006 to 2014. So he basically maneuvered the US from the central bank side through the financial crisis. And he used some unprecedented policies based on his research, because what is maybe not so much known in the public is that Ben Bernanke was already a very well-established economic historian who published very influential insights. I will talk about that in a second. Douglas Diamond is maybe less known, but at least among financial economists, very established scholar at Chicago Booth, since 1979, professor, and he published very, very influential papers, mainly in financial economics theory that shapes the way we look at banks and the financial sector in general today. And the third, maybe least known person is Philip Dybvig. He's also a financial economist and a professor at Olin Business School and at WashU University. But he's less known because basically after he published this very influential paper with Diamond together, he changed the topic, he changed his interest. So he was not working on banking anymore. And he also became a quite established musician. So a very talented person on many sides. But why should we give the Nobel Prize to those researchers, what have they found out? That's what I want to talk about today. So let's start with Ben Bernanke, as I just told you, the economic historian. So what was his work about? Ben Bernanke, during his PhD and afterwards, analyzed bank behavior during the Great Depression of the 1930s. And what he showed was that bank runs during this depression were the decisive factor in making the crisis, the economic crisis, longer and deeper than it would have been otherwise. And I don't know about your school education, but I'm German. I come from Germany and I went to school in Germany. And I remember very well that whenever we talked in school about this Great Depression, we talked about the Black Friday, the stock market crash, and then the economy collapsed. And that was for a long time the very established view. But this is what was basically challenged by the insights of Ben Bernanke and the work that was then built on his work, that he said, no, it's not the stock market crash that caused this deep recession that stayed for so long and that pushed many people in misery. When you look basically at the time lapse, the stock market crash, the Black Friday, triggered a banking crisis that went on for at least 3 years in the US and also in Europe, where deposits were withdrawn and banks collapsed, where we have all these old pictures of people queuing up in front of banks, withdrawing all their savings. So basically, the whole banking system and their role of allocating capital to the most efficient firms that needed those to make new investments, to pull out the economy of the crisis, out of the crisis, this collapsed in the aftermath of this stock market crash. And since this very influential work of Ben Bernanke, this is very well established. What we know, or what we knew afterwards, what we learned, is that there's basically two types of financial crisis. There's these pure asset collapses, like we have seen in the dot-com bubble, or like we have recently seen in the cryptocurrencies. Those crashes destroy a lot of wealth of those investors invested in the asset, but they have nearly no influence on the economic outcome and the further development of the business cycle. What causes a deep recession, this link between financial crisis and the real economic crisis, is how well the financial intermediation, in particular banks, are recovering from such a financial crash. And whenever we have this banking sector or the financial intermediation in a broader sense being also affected, this is when crises become long and severe and affect the economy and the real outcomes. So this is something that was established by Ben Bernanke's work, and then a lot of work followed. And what was known since then, based on his work, is that bank runs are linked to financial crisis, and this sudden losing of trust in the banking sector is very severe for economic outcomes, because bank runs and this lost in trust make crisis longer and more severe. The recovery takes longer if banks, the banking sector is in crisis as well. But what were the driving mechanisms of this? Why were suddenly people, after such a financial crash, losing their trust in the institutions and queuing up in these long lines in banks, in front of banks, and withdrawing all their capital at the same time? This was not very well understood. And this is basically the contribution of Diamond Dybvig, 1983 paper. So until 1983, financial economists would think of banks as fulfilling the one major role. They would create trust such that investors would be willing to provide their capital to those in need to make investments that would cause growth and flourishing economies. They would do that by monitoring borrowers to guarantee that the best borrowers and the most trustworthy borrowers would get the capital that they need. So a very important role. But Diamond Dybvig now introduced a new perspective, well, now in 83, that this is not the only role, because while investors are risk averse, and that's why they want or they prefer banks to monitor. So this first role, there's also another preference of investors, and this preference was not thought about before. We have a preference for liquidity. What does it mean? We're not, when you think about yourself, if a bank or any financial intermediary offers you to invest risk-free your investment for 3 years or for 10 years, totally risk-free, but at the same rate, you would have a strong preference, I assume, to invest only for 3 years. Why? Because you don't know what's coming after. You're not indifferent between the two. So you have a strong preference for flexibility, because we all know that things can happen in the future that we can't foresee. So we prefer to have at least part of our wealth at our request whenever we need it. And this provision of liquidity is another role that banks provide. And that creates wealth, because it makes investors more willing to invest. It allows us to consume more in the short run, but it also inherently creates a fragility to financial institutions that offer these services, because otherwise healthy banks that don't have any trouble on their asset side become fragile to what we call in economics pure panic runs. And how these mechanisms work, I want to explain to you in a very, very hopefully straightforward and simple way. So no formulas, promised. But here comes the potato. Because the Diamond Dybvig model sounds like as if it was about money and money creation, but actually the whole model is in real terms. So it's not banks creating money, but it's banks investing in real assets using real value capital to allocate it to investors. That's why I will, instead of deposits and investments, I will talk about potatoes today. Because the basic Diamond Dybvig model consists of a very simple world. A world that consists of 3 dates: today, tomorrow, and a far-off future. And today, every one of us, let's say, owns a potato or a certain amount of potatoes. And now we have a choice to make. We can simply put the potato in a dry and dark and cold cellar and then consume it tomorrow or in the future, 1-to-1. I hope you all had dinner already and you don't get too hungry by this picture. So whenever we need it, we can just have what we stored there ready to consume. The potato is a real asset that creates real value for us just by the pleasure of eating it. And that we can do today or tomorrow. But a real potato is more than that. It's a real asset because it can do more than just being consumed. You can also put it into the earth today, wait tomorrow, and then in the future, you can enjoy real returns on your investment, right? You can invest today and enjoy a future return of many, many potatoes. And in the Diamond Dybvig model, we abstract from any risk. So there we can add that later on. That's very simple to introduce, but the model itself doesn't consider any actual risk. The panic in the end is created by the structure of the financial contract and its optimality. What I mean here is, in our simple model, The potato does not mold. There will not be a drought or a flood. So we know for sure that one potato creates, like in this picture, 7 other potatoes in the future, for certain, without any risk. But while this is a very nice investment, it has a problem, because we all know, or at least if you already planted potatoes and tried to see what's happening to the potato later on, then you know there's a drawback. You have this investment for the future. So at a future point in time, you can consume many potatoes. But if you need to consume tomorrow and you dig out your potato, it's not the same anymore. And it's usually much less in value to you to consume the potato that you have invested. This reflects the idea that when we do a real investment and we need to liquidate it in between, that it loses value. Like, because the investment can be very firm specific. It might be a machine that nobody else needs, or it might be because there is no market liquidity at this point in time when you need to liquidate it. Right? So that's the basic technology that is existing in our simple diamondific world. We have 2 technologies that we can use to what to do with our potato. We can store it and consume it at any point in time, or we can invest it, get a higher return in the future, but then it has the drawback that tomorrow we cannot consume much out of our investment because there's liquidation costs. But who should invest in the first place? Well, there diamondifics say, well, there's a mass, some society that has to individually think about how to maximize their utility, how to maximize their wealth in the end, how much they can consume, how many potatoes they have in the end, and how much pleasure they got from eating the potatoes in between. And if we were all the same, there wouldn't be much of a problem. But actually, they say they introduce a heterogeneity among us to introduce this idea of uncertainty. So what they say is, well, there's basically 2 types in the society. Of course, this is a very big simplification of society, but it captures the main idea. There's what they call an impatient type. And you can think of that as an impatient type in terms of, well, it might be that tomorrow your car breaks down and you have to fix it. So you need to get some of your wealth from your savings to repair your car, right? That makes you impatient. You want to insure yourself against urgent needs of liquidity in between your today's investments and your future returns. But you can also see it from a brighter side. We can also see, well, there's these impatient guys that just have amazing ideas, and maybe they have ideas about creating a product or a service, or they want to invent something to make our world a better place. And they need capital to do so. And if they get this capital, they can create growth and a flourishing economy for all of us. So that's another interpretation of these impatient guys. And then there's the rest of us who doesn't have these urgent needs of consumption, this urgent need of capital, because we don't have great ideas. We will just enjoy our future returns of investments, right? And if we would know today which type we are, there wouldn't again be a problem. Then we would just choose, well, if I need capital tomorrow because I will have a genius idea, then I would just store my value and consume everything that there is. If I will not need any money or any potatoes tomorrow, if I don't get hungry tomorrow, then I can just invest everything and will benefit from all the returns from my investment. But the problem is, and that's also the case when we think of our lives. We don't know if and how much of our savings and capital we need at each point in time in the future, right? What we more or less know is there's a certain, yes, please. Was that a question? No. Okay. What we know is there's a certain chance. And to make things simple, scientific assume, well, we know that there's a certain proportion of impatient people. So 25%, for example, will have great ideas, will need capital to invest in even greater ideas. And the residual 75% will just enjoy the future returns of their investments, and they don't need to consume in between. But we don't know who it will be today, but we have to decide today what to do. So, well, let's think about it. What would be the optimal decision today? Well, a naive answer would be, well, if we know there's a 25% chance, then we can just store 25% of our potatoes, given that we can store 25% of one potato, and we could invest the rest. But could that really be optimal? And you will see, no, that's not really the case, because, well, consider tomorrow you turn out to have a great idea, or to really need your capital because something bad happened to you. Then you have stored 25% of your potato that you can use immediately, but the residual wealth you have to liquidate from your investment, and you get much less than the value you would have if you had stored your potato. So you regret that you didn't store everything. So tomorrow, if you're impatient, you prefer to have a full cellar of potatoes that can be consumed immediately. And similar, even if you turn out to be patient, well, at least then we don't have to liquidate anything, but you will also regret, because you have to invested 75% of your wealth into investment, enjoying all the 7 potatoes per investment. But the residual 25%, you're regretting, because they are only stored in the cellar, while they could have produced many, many more potatoes if you had invested them, right? So this problem can actually already be solved with financial markets. So we don't need exactly banks for it. But let's think about it as a bank. What is a bank doing? Well, nothing very specific here, because we don't have risk, so we don't need the bank to monitor anybody. The bank only needs to be trusted that they do the right thing for us. And Diamondific assume, yes, we abstain from, so they neglect any moral hazard. So there's no bad bankers, there's no bad people that well, can do something that is not in the interest of investors, but the bank simply maximizes our all welfare. So what does the bank do? It collects all the potatoes from all the society, and then simply does what we wanted to do in our naive approach individually, but collectively. So they pool the potatoes, invest 25% into the storage. This is core deposits for the bank, right? Holding liquid assets to be able to provide liquidity at any point in time. And the residual 75% are invested into long-term assets in our long-term, they are invested into growth of potatoes, or when we think of banks or financial intermediaries, they are invested into corporate loans, into mortgages, into assets. They take a long time to mature, right? So they basically do exactly the same thing, but because it's pooled, there's no individual regret. And all our individuals get exactly what they want. Because if I tomorrow wake up and I'm an impatient person, I have a great idea or something bad happened to me, I can just go to the bank and get my potato back. So 100% of my initial wealth is given back to me, right? There's no loss, there's no liquidation. We prevent any liquidation. And for everyone who's patient, who didn't want to liquidate, he can wait until tomorrow and in the future and enjoy 100% of the investment return, right? And as I already mentioned, this outcome, when we think about it, and that's also something that Diamond Dipvig already mentioned, can already achieve by financial markets. So here we don't really need banks because, well, we could basically trade futures, right? So even if we invested individually, instead of liquidating our investment when we turned out to be impatient, we could simply sell this plant of potatoes to the patient guys that give us their stored potatoes so that everyone would actually get this outcome. So what is it, what banks do, what makes them special? Well, what banks do that makes them special is the following. They do more than just promising one potato today. They promise, or tomorrow, they promise more than that. So the idea is here that, well, individually, we are risk averse. So we don't like to have either a high return in the long future or a really small consumption today or tomorrow when we turn out to be impatient. We actually like to smooth our consumption. Or coming back to our idea of these impatient guys not only being something who experience something bad that they need to liquidate their assets, but this could be guys that have great ideas that push forward our economy. And those great ideas not necessarily only need one potato as capital. They might need investments that are greater than that, than what we can store and provide in cash. So basically what banks do and financial intermediaries can do is to get something of the real value from the future and promise it to us tomorrow. So everyone is better off in the end. Because we allow greater ideas to be created and financed in the short run by promising some of the return that will be created in the future. And since this is all pooled, this is all possible in the banking contract. And that's what actually creates value for the economy, that fosters innovation and allows economies to grow. But by fulfilling this role, by doing this magic of promising future potatoes to us tomorrow to consume or to invest into great innovations, we also create this inherent fragility. And that's the major insight of the Diamond Dipvig model. What do I mean with that? Well, imagine for some reason, not only all the impatient guys who have great ideas turn up at the bank to say, well, I had a great idea, or my car broke down, I need to consume my potatoes now. But the bank cannot really distinguish between an impatient person or a patient person. You cannot control who has a great idea, who doesn't, and therefore needs their wealth back to invest or to create those ideas. And if it's not possible to control who deserves to get their savings, so this is not about loans and credits, this is about your savings, right? So the bank cannot really deny you if you have a contract that you can get your savings at any point in time for the agreed 3 potatoes. It cannot deny you this in the short term, because that's what was creating value in the first place. But let's just assume that the patient guys now, for some reason, also start to ask for their potatoes back. And that don't need to be all the 3 potatoes. It could still just be 1 potato. If they start to ask for their promised returns more than what the bank had actually stored, the bank has to start to liquidate the investment. And the more it does this, the actual assets that are creating the future values vanish. And that's the so-called bad equilibrium, because it is an inherent equilibrium. Why? Because even though you might ask in the first place, well, why should these patient guys, or these happy ladies in this case, why should they actually ask for just 3 potatoes today when they can have 5 in the future? Well, individually, it doesn't make sense. But as a group, it does, because what happens if all the others do it is that in the future, there's nothing left. So if I simply assume that everybody else is liquidating the real investment or is asking for their deposits, so the bank has to liquidate its assets, it is the dominant strategy for me. It's the best thing I can do at this point in time to also do the same. And that's what we call panic runs. And the very interesting insight here is that there's no risk. There was nothing that forced the bank to liquidate except this promise that everyone can get their savings at any point in time. So this promise of, or this liquidity insurance for investors that create value, at the same time makes the bank fragile to these panic runs. And when they occur, they're usually fast and they don't need to be very rational. So it can occur even if there's just some rumors. Of course, then you can argue, well, in the real world, what we see is usually there is something bad happening, a financial market crash, the economy is going down, and then bank runs occur. This can be added on top here. So if there's rumors that my bank has suffered some losses, that maybe some of the real investment went bad because there was a flood, so not all potatoes actually turned out, or not all potato plants are growing potatoes, then of course I would reinforce this panic run even more. So we would have a fundamental reason to run on my assets and to liquidate my assets. And on top, we see these panic behaviors that aggravates, that makes it much, much more severe, those panics, and they occur more often. And they can spread among institutions, even if those institutions are not necessarily linked by the assets. So that's already the key insights from the Diamond Diptych model. So that's what they got the Nobel Prize for. This insight by providing liquidity insurance, so by financing illiquid long-term assets with liquid short-term funds, by offering us investors the chance to withdraw our wealth at any point in time, while the bank has a certain amount and a major amount of their actual of their liabilities invested into assets that are illiquid, that cannot be liquidated in the short term without any cost. By allowing that, the banks play a crucial role in the economy. They create wealth. That's why they are important and different from other financial contracts. But also because of these roles, otherwise financially sound banks, and that's the crucial point here. This was a healthy bank. Nothing bad happened to the healthy bank, but still there is this bad equilibrium where it's rational, where it's the best thing I can do, as an investor, if I think that all the other investors do the same, I will liquidate my assets or force the bank to liquidate all of its assets, and therefore the financial institution becomes illiquid and eventually insolvent. Even though if I would have just stayed at home and everyone else who's patient, the bank would be in perfect financial health. And another insight from this model is that, well, if a bank or any financial institution that funds illiquid assets with liquid short-term funds, if we know that such an institution is fragile to these pure panic runs, they can be prevented. So if we would know that a certain institution is suffering from a pure liquidity crisis while being otherwise solvent, there's a very easy and cheap way out. And you might remember.
There's another message that I want to tell you today, is that within our mandate, the ECB is ready to do whatever it takes to preserve the euro.
So that's the way out.
It will be enough.
Believe me, it will be enough. If investors believe,
there's another message.
If investors believe that some higher institution stands behind the financial institution and just provides stored potatoes whenever they are needed, we don't see these panic runs anymore. Because it's a self-fulfilling crisis, it only occurs because everyone thinks that everyone else is running and therefore potatoes are thrown out of the earth. If I know and believe that the government or the central bank provides stored potatoes instead of liquidating my asset, suddenly I don't have a reason to ask for my potato anymore. And that can be seen in the banking sector. So after we have seen this big banking crisis following the great the stock market crash and causing the Great Depression or the severity of the Great Depression, deposit insurance, lender of the last resort schemes were introduced, which basically erased this pure panic-based runs on bank. We still see crises, but those crises, at least for the traditional business model of banks, was caused by losses on the asset side mainly. And then by other institutions that are not guaranteed by the state, that are not protected by the lender of the last resort policy of the central banks. So what's the relevance of this whole insight for our economy today? I mean, we have seen all these pictures of queuing people in front of banks. Is that really something we have to be concerned about anymore? Now, as we have deposit insurance, lender of the last resort policy, and government guarantees, and Mr. Draghi saying, whatever it takes, we will always defend our financial system. Well, first, you might remember Northern Rock as an example. During the financial crisis in 2007, 2008, we have seen actual bank runs when it was not clear that governments could actually back up the banks. We have seen in Iceland banks crashing because basically the GDP of the country was not big enough to convince investors that they would be able to provide enough stored potatoes in case of a crisis. And we have seen then that even more recent, there was a famous 3 days bank run in China in, let me remember, in 2013, 14 it was. Because until then, China didn't have a deposit insurance scheme. And what happened was basically that there was some, social media popping up, rumors in social media that somebody wanted to withdraw 200,000 won, and he couldn't get those from his bank. And suddenly people started to worry that they couldn't withdraw their potatoes, and therefore they all queued up. And this 3 days bank run was solved by basically the banks starting to pile up one in front of their teller machines, in front of their tellers, to show we have plenty of potatoes here. All of you can get their potatoes back. We don't have to liquidate. We don't have to destroy any plans. And then this, when the public was convinced of that, the bank run stopped. And in the aftermath, China also introduced a deposit scheme. But then we can think of other institutions that are not under the umbrella of the lender of the last resort, that are not protected by governments or deposit insurances, like money market funds, where we see strong withdrawals that are panic-like whenever there's bad news. We have seen that in the financial crisis. We have seen that also recently in reaction to COVID news. So very similar idea. We have long-term assets. We have everyone invested in the mutual fund can withdraw their money if needed. And whenever investors start to doubt that they will get their actual money back, that the money market fund might break the bucket, then we see this behavior. And more recently, even, I promised to talk a bit about stable coins, or, well, let's talk about less stable coins. This is a very, very similar mechanism. We have an asset, a crypto asset, that has a value we believe in. And whenever we stop believing in, it is the best strategy for everyone to also sell it as quick as possible, because it's a self-fulfilling crisis. So we see in cryptocurrencies this new kind of bank run, as Bloomberg has called it. And much more recently, we have seen this, hopefully starting now. So,
like I was saying, it's FTX. It's a safe and easy way to get into crypto.
I don't think so. And I'm never wrong about this stuff. Never.
So don't miss out on FTX. I don't know if you read that as a little funny side story of this FTX crash, which you hope obviously has been in the news. So during the Super Bowl, there was an ad from FTX, a crypto exchange, where Larry David sarcastically predicted that, well, FTX wasn't going to make it. He was also doing that, his characters throughout history, naysaying humanity's greatest inventions, the wheel, the light bulb, coffee, and democracy. But in the end, he turned out to be very correct, because when we what we could see,
like I was saying, it's
well, was this trading platform, a trading platform for cryptos, suddenly collapsing. And why was that? Well, this trading platform was linked, and far too much linked, as we now know, to Alameda, an basically hedge fund reinvestment fund. And Alameda's balance sheet you can see here, and this is the actual balance sheet that was leaked, including the comments saying hidden poorly, internally labeled at fiat, and so on. So this is already showing, well, maybe they had other problems than simple panic runs. But what basically happened that caused this crash, this sudden crash, was that Alameda was hacked, and 5 billion of withdrawals appeared on a Sunday, which resulted in liabilities of, well, a very large number, backed. And here you see that that's the liquid assets that Alameda had at this point in time. And this balance sheet was leaked, so investors would see there's a huge mismatch. And what's even worse, the more long-term assets, that the potatoes that were invested in the earth, producing more potatoes in the future, they actually consisted of the platform's own cryptocurrency that has a value as long as you believe it. And also it consisted of Serum, another cryptocurrency in which Alameda was heavily invested. So it became clear that once they would start to sell off this illiquid asset, once they would start to sell off Serum, they would draw down the prices of Serum dramatically. And therefore, the overall value of their long-term assets were very questionable, not even to mention other asset positions like Trump Blues, where it's still a bit questionable what this actually was. So the Financial Times invested into it, but I haven't found yet if they have found out what those positions were. You can make your own stories up here. So I found actually on Twitter this nice summary of the recent events that we have seen. So this is not my own invention, this is what I found. So we have seen Terra Luna crashing, 3 Arrows Capital, a Singapore-based cryptocurrency hedge fund, crashing similarly, FTX Alameda, and then this, the author of this meme indicates here that there might be now other implications from Diamond Dipvig on the financial health and mechanisms of Binance and Tether. And what I found most interesting in reaction to this is actually the tweet of the CEO of Binance, who was also a bit involved in the crash of FTX, but don't want to go too much into this. But apparently he's aware of Diamond Dipvig, because what he suggested the next day is to form an industry recovery fund. So apparently he suggests here to move into the next era of, to guarantee the value of cryptocurrencies traded on their platform, to use the power of this creating trust, of backing up the trust into the asset and the liquidity of the platform to prevent another crash. So that was the basic insights I wanted to give you today. I hope I made clear that the Diamond Dipvig model at first explained why banks are special, because they provide liquidity that makes them special compared to other financial market contracts. The model improves our understanding of panic crises, so of pure rumor-driven crises that can accelerate crisis that is caused by fundamental losses on the asset side. It offers guidance to understand potential collapses of many different institutions. We have seen banks, we have seen money market funds, crypto trading platforms, stable or assumed to be stable coins. And the basic idea behind those collapses are always that there's short-term liabilities. Investors are able to withdraw or not prolongate their liabilities at any point in time or in between potentially illiquid assets. So these funds are used for investments that cannot easily be liquidated, or if they are liquidated, like the positions that Alameda had in Serum, for example, if they would have liquidated this position, the price of Serum would have dropped so sharply, and then that's also what happened, that their actual assets kind of imploded. So the value of the asset was linked to their own position into them, and then you have very reinforcing effect of such a panic run. And I hope that this also made clear that we have a lot of insights for regulatory actions, not only from the public sector. We have seen that, well, it can be very, very successful to step into the public and declare we do whatever it takes. And this is actually something that the CEO of Binance just used to calm down the crypto markets and to declare we will make sure that our cryptocurrencies are traded at stable prices, and we will provide the liquidity necessary for that. And it seems, at least for the moment, to have worked, as much as Draghi was able to calm down financial markets during the sovereign bond crisis. So what works is public guarantees or private deposit insurance. And here central banks for banks play, of course, a major role as providers of the lenders of the last resort. I thank you very much. And if you have any questions, I'm very happy to answer them.
Thank you very much, Eva, for your thought-provoking presentation. So let me open the floor to anyone who might want to ask questions to Professor Schliepak. Well, if nobody asks, I'll ask myself. Deposit insurance, one of the limitations of financial integration, monetary unions in the EU area is that we don't have common deposit insurance. Deposit insurance is still run on a country-by-country basis. Do you think that creates some fragilities? Some countries might have a banking sector too big for the capacity of the country to sustain them in case of a crisis? Could that be a problem?
Certainly. I mean, what Diamond Dybvig did not take into account, and what we, of course, is something I left out, is that there's also a drawback of deposit insurance, right? I mean, there's this bright side that guaranteeing, the investments of depositors, at least of the savings of small households, really prevented this kind of run behavior, which, then would, if we really are willing to integrate in Europe to the extent that sometimes we try to, would require at least a mutual fund or European deposit insurance. But this is, of course, a politically very difficult topic, because there's also drawbacks. And the major drawback that we know from guaranteeing the safety of the bank is a too big to fail problem, is the problem that institutions, once they know that they will be protected, once they know their depositors simply feel safe because they are safe, they are protected, then we don't have a punishment mechanism from the investors to prevent misbehavior, to prevent excessive risk-taking, right? And that's the main argument against such a European deposit insurance scheme, that, well, once all the banking sectors are protected on the European level, then the national banking sectors could make use of this and go even more into excessive risk-taking when they are not properly capitalized. I'm not saying that this is exactly the case and necessarily, but as everything on the European level, this is, of course, a highly political thing. But we could have prevented some of the sovereign bond crisis extensions by such an insurance scheme. we might at certain point in time have to do that. For example, if the Italian banking sector would go again into a severe crisis, then we know that Italy will not be able to rescue this sector, and that would have severe consequences for the euro area overall. Then the topic will, I guess, become, excuse me, important again. But it's a step that countries, or some countries, are not yet willing to go. And as a result, what happened was that, excuse me, that Mario Draghi had to step up. I mean, that's why the ECB basically filled this gap with a quantitative easing policy, with allowing Greece banks to lend based on government bonds that were not AAA anymore. Sorry. I can speak. You don't have to be nice. If there's more questions.
Yeah, may I present a question? Which is basically the following one. I know these kind of actions, deposit insurance, somehow, they relieve certainly a liquidity crisis. But the point is, over the recent years, we saw enormous correlation between credit risk and liquidity risk. And the point is, somehow, at what level, what you referred as liquid assets, and somehow they face the problem. What is the true valuation over time that the asset has? So the point is, at what level, what kind of actions somehow need to be implemented in order to not kind of mix, what is well intended as providing liquidity to ensure depositors, but at what level is we are providing liquidity could somehow to improve the mark of a pretty liquid asset, which by other probably means a pretty risky asset also.
Exactly. Yeah, very good point. I think, the most clear this becomes with the current cryptocurrency crashes, where we really, what's the true value of a cryptocurrency? It's what the market believes, right? So there is a strong correlation between the value, the actual fundamental value of the asset, and the liquidity of the asset. If there's no liquidity, the asset has zero value. We have seen with Terra. And as long as this is purely known and investors speculate, this is something where we could say, fine. It's very difficult when it comes to, financial institutions such as banks. I think this was the biggest topic since the financial crisis 2007, 2008, to kind of, to distinguish what is an illiquid bank, what is an illiquid institution from what is an insolvent institution, right? So where are there real losses so that we have to resolve this institution? And the Fed made this experiment of resolving Lehman in the hope that, Lehman was basically owned by foreign investors, and that wouldn't have such bad feedback effects. In an attempt to say, there is no institution that is too big to fail, because the markets have to, the financial institutions have to behave. They cannot be rescued all the time. You have to be strict here. But what was a very good intention, then we know turned out to actually prove the opposite, right? This came back as the financial crisis, making the problem even bigger, because basically the Lehman crash, or letting Lehman fall proved that there is indeed an institution that is too big to fail, and that this would never happen again. And then you create, I mean, this creates, of course, a lot of problems for incentives to take risks, to invest in assets that have questionable market values. And I think, well, the way to go, or at least that's where central banks and supervisors go, is to work on the resolution, and especially international resolution, to better, so what they call bail-in at this point of time, to kind of better understand which investors should actually be allowed, or which investors should be forced to actually take the risk. And I think the common sense is to say, well, not the unsophisticated depositors, that those can just stay secure. They should not have the decision when a financial institution is fragile and whatnot. But the to the bigger investors, institutional investors, have to bear this risk, and there we need proper rules to allocate basically the losses between investors in case of asset losses that push institutions into bankruptcy. But I think even so long after the financial crisis, this is still something that is very difficult, especially when it comes to international financial institutions, how to resolve them. Because then we are talking about, conflicts between countries, where everyone wants to push the losses to the other countries. And I mean, we are not even able to solve this properly in the European Union, not to even think of how to proceed for the UK, the US, Hong Kong, Singapore, how we deal with those institutions if they get into financial trouble. I think that will be one of the major challenges in financial economics, or for regulators and supervisors. There's a lot of research on it, but in the end, it's a political question again, and there's a lot of national interest in protecting the own players. I don't know if you agree. You can, of course, disagree. And
I fully agree with you.
Well, if there's no more questions, we'll close the session. I want again to thank Professor Eva Schliepak. I know it was a strain on your voice. We all could see how much effort you are having to go through to give the lecture. So on behalf of Mastering Finance program, thank you, Eva, and thank you all for coming, and have a rest of a good day to you all.
Thank you.
Thank you for having me.
Thank you.
Thank you.